Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Also, if you're looking for a great place to manage your salespeople's contacts as well as their deals that they're working, check out Arrow at heyarrow.com and look into their great products there. As normal, I have Shawn Hackett on here with me, and for whatever reason, I thought today was Wednesday. It's obviously Thursday, or Shawn wouldn't be on the podcast. Don't know why I want to replay Wednesday again, but nonetheless, Shawn is here with us. Shawn, how you doing this morning?
I'm doing good on a Thursday.
All day long Thursday, full day.
That's what I was told. What I was told. So
Right on. Well, Shawn is with Hackett Financial out of Boca Raton, Florida, and Shawn is always gracious enough to come on and talk about what's going on in the marketplace. And Shawn, typically on Thursday we talk about what's going on in the soft market, kind of hit the coffee market and those kind of things. But before we get there was one topic that I wanted to hit on a little bit and kind of reiterate what we've been talking about, which is no big surprise to anybody out there at this point. But I was reading an article this morning that there was global food prices have hit 10-year highs. And so we're talking about that inflation. We talked about a little bit of inflation last time you were on. I had recorded a podcast with Rich Poston that I'll be putting out here in the next day or two to put that out there. And we spent a lot of time talking about inflation. I guess as you take a look at what's going on in the marketplace, especially like you just got back from your coffee tour in Brazil, or you're anticipating some short crop this year. So basically everything that we've got so far this year is going to be a short crop. It's not so much that the bushels aren't going to be there, but it's the quality of the bushels that I think is going to be the biggest impact on the market. So you take this high inflation that we're seeing now, you take shortages around everywhere else, and it's just we're kind of setting the table for just higher prices going through 2022 into 23.
well, I think you have to remember, Casey, a year ago, so many producers in so many different ag markets sold a lot of supply cheap. And so they did not benefit from all this increase in price. In fact,
That's right.
They locked in a much, much lower price. And now all their expenses are going through the roof.
Yes.
And so what's happening is they realize they made a terrible mistake. And now whatever supplies they haven't sold, they are holding on very tight-fisted because they're saying, hey, you know what? I screwed up. I didn't get the income I needed. I'm not in great shape. I need to make the current supply I still have from last year's harvest, go as far as I can. And so I'm going to be much tighter fisted on the supply than I was a year ago. That's the first thing. Second thing, obviously, with all the problems with weather, with all the problems with delivery delays and logistical delays and people not getting things when they want it, the markets, we talked about this last time, the market's worried about the security of supply. They want more on hand than they had before, and they want to get it now. And so it's causing this extra demand base to come in beyond what's actually needed, because every country, every government every consumer is saying, you know what, I just feel uncomfortable. I want to have a little more food on hand because I'm not comfortable with what's going on here, especially as we go into what could be, a pretty long, cold winter. So that's the second thing going on. And then the third thing that's really going on is you have, how can I say, you kind of have this post-virus government monetary policy response, meaning, trillions upon trillions upon trillions of dollars have been or going to be spent. Trillions upon trillions of dollars have been and will continue to be printed, all in reaction to, the pandemic, the shutting down of the economies. And we, quite frankly, we did more on monetary and fiscal policy in the last 2 years than we probably would have done over the next 15. And so that is just an amazing experiment. I call it an experiment because quite frankly, we've never really done it before unless it was in wartime. And so all that's going on that's making people losing confidence in the purchasing power of their money and losing confidence in the governments that they are citizens of. And so when you lose confidence in your purchasing power and in the government that supposedly is representing you, you take your money and you put it to work. You put it in stocks. You put it in real estate. You put it in commodities. You put it somewhere that is away from the cash side of the aisle. And so from the investment capital flows perspective, we're seeing a lot of money going into assets and away from cash, bonds, and government entities. And so that trifecta, for lack of a better term, is really driving this inflationary period. And I really don't see right now anything that's going to shift this in 2022. In fact, most of the things we see, Casey, are actually going to accelerate these trends in 22.
Yep.
So
the fertilizer thing is getting to the point where it's getting to be a big deal. We had some conversations with customers just the other day that we were talking about, what's your mix going to look like with the way fertilizer is. And they were, we might try some soybeans, and soybeans aren't a big deal out here. I mean, they're kind of slowly growing because of the altitude and those kind of things, but they're slowly kind of making their way, and more people are testing them. There's some different varieties out there that are working out here. And there's some guys that said, we might try more soybeans. We might plant some more wheat than we typically have in the past, and those kind of things. So it's just that crop mix is starting to really play into some decision making for some people. And there's some folks that are just corn on corn, and that just is what it is, and that'll continue to be that way. But it will be it'll be interesting to see what that crop mix looks like as we move into that March prospective acres report and what that looks like.
Well, of course, a lot will have to do with what do prices do between now and then. Does corn go to 7 before then? Is it stay in the mid 5s? Our work suggests that low to mid 5 December 22 corn will not deliver the acres and will not deliver the yield. It will not deliver on the kind of fertilizer usage that will be required to produce a big crop. So either the market's going to wait for that reality and then take off, or the market's going to start to take off to try to avoid that reality. Usually the market's supposed to be forward looking, and so our anticipation is that the market might start moving up. Remember, the February timeframe is when insurance premiums are set, or the price for crop insurance is set. I would think the market's going to want to set a pretty high number so that farmers are comfortable, that they're insured for a higher number, and it gives them confidence maybe to put that expensive crop out there more than they would be willing to today. That's our speculation. We'll find out. But under no circumstances is low to mid 5s going to work under most circumstances that we're looking for. And so we continue to believe that livestock producers, should be looking out at those deferred corn prices and be looking to lock it in, especially on any corrections we may see, because there's always going to be setbacks in markets along the way. We just think that's a really, really great value for long-term feed needs right now.
Right on.
So,
all right. So let's jump over and talk about milk for just a little bit, what that looks like. So Milk had a pretty good run, and it's like everything else. We kind of seen a jump up when it was kind of down there, but here lately it's been in that $18 to $19 range, which that's a profitable range for most dairies. We start looking at how the market works and those kind of things. But it's been falling off dramatically here over the last week or so. So I guess talk about the dairy market a little bit and see what's going on there.
I think we need to separate the long-term picture from the short-term picture.
Okay.
We just put out a dairy report beginning of the week, and we actually turned a little bearish for the first time, and we put out major buy recommendations in July and August, and we thought that Class 4 and Class 3 could approach that $19 number, and it's exactly what it has done. So we kind of got that forecast pretty solid. We're worried, though, that the market might have gotten a little ahead of itself here, that we could be setting up for a correction here into the first quarter. Seasonally, the milk market likes to do that. If you kind of look at the historical buying patterns of China, they tend to buy most of their milk powder in the fourth quarter, and then they walk away. So there's a reason why we have this seasonality of peaks in the fourth quarter and then falling off into the first quarter. There is a shortage of milk in China. They are buying a lot. We are seeing the prices rise, but we kind of feel, when you look at the historical pattern and the historical resistance, 19 level, a little over 19, we think this is probably not going to be exceeded right now. We're wildly bullish, by the way, dairy prices into spring, summer, and fall. So I don't want anyone to think that we're not long-term bullish. We are, but we do think we could have some kind of, a 50% correction of the rally that took place before we set the stage for a much, much more dynamic move to the upside, where we take out that 19-20 cent area and potentially go to new all-time highs here in the dairy situation. So we're suggesting, and we did suggest earlier in the week, that dairy producers might want to think about protecting this price into the first quarter. Not a major deal, but just be careful not to get caught selling unprofitable milk in the first quarter. We think there's a risk. And already Class 3 prices, by the way, have broken hard here the last couple of days. So it looks like maybe Class 3 is already beginning to do that, whereas Class 4 so far has held its ground. But we're pretty comfortable that that's something dairy producers ought to be thinking about.
Okay. So here's a market that only thing I know that I'm getting out of it is chocolate and hot chocolate, the cocoa market. Talk to me a little bit about that and explain its importance on the overall market spectrum.
Cocoa is very unique. 70% of all production is grown in two countries, Ivory Coast and Ghana, and in Western Africa.
Okay.
Everyone else really doesn't matter.
Okay. Right on. All right.
I mean, it just doesn't matter. It's just that those two countries, and it's very unusual to have just such a small little area control the whole thing, but that's the way it is. So La Nina historically tends to be good for West African cocoa production. It tends to bring in good moisture. It tends to be good. And we've had some very good crops the last few years. And so we continue to have good weather in West Africa. And of course we've had all this, chocolate isn't necessarily, the first thing you're going to go stockpile, right? If you're worried about food, you're going to,
right.
It's a luxury item, right?
Right. Yep.
So demand is improving like everything else, but I don't know. I think in a situation where inflation is contracting the disposable income and purchasing power of consumers, I just don't think chocolate is getting on top of the list right now. And so demand is okay, but sluggish, and you have good production. That means a market going nowhere. And the market's been going nowhere. It's been stuck in a kind of a sideways trade. So what's going to change that? Well, given that we really don't see the inflation side getting any better, and given that we don't think the economic situation is going to get any better, demand is going to stay the way it is, which is kind of sluggish and growing slowly. So it's got to be production that's got to knock this market higher. And usually El Nino weather pattern is what catches Western African production. It brings in hot, dry weather at the wrong times when the tree crop is developing, at the sensitive stage of pods and that sort of thing. And we believe we are, as we've been talking about, that La Nina is going to go away come the spring and be done. We're not, that'll be the end of the La Nina phase, and we believe that in the back half of next year, we're going to develop an El Nino pattern, and so that's kind of what we're looking for, Casey. We're kind of looking for when do we feel the price is established, a low enough price to factor in the bearish part, and at what point are we willing to start making bets that the weather's going to start entering this hotter, drier phase. And so our best guess right now is sometime in the spring, we'd be interested in looking at the buy side of this market. Right now, we think it's a trader's market. You buy the low end of the trading range, you sell the upper end of the trading range, you sell the upper end of the trading range, you buy the lower end of the trading. That's not what we do, Casey. We're not channel trading. That's not what we offer. We look for hedging opportunities for our producers, and we look for long-term trends. We tend to stay away from sideways trading markets, but that's where we think cocoa is at. It's a very cheap market. It's a very interesting market. It's a market that we think has huge upside, but we still think it's a bit early yet to really take it seriously. On the buy side, we think we need a little more time. So,
understand. All right, let's talk about cotton for a minute. Cotton is still up there. China's still, stockpiling as much cotton as they can get their hands on, quality cotton anyway, they can get their hands on. We're going all over the world looking for it, and lo and behold, the United States is still one of the only places that you can get good, high-quality cotton. I know Australia's got some action down there, but for the most part, they're still buying from us. So I guess as you take a look at that market, I think right now I'm looking at the market here. It looks like it's $1.18 a pound. So that's pretty impressive. So I guess as you look at that, how much higher can this go?
Famous last words, right?
Exactly. Exactly. Yeah.
Well,
it's kind of like just one more, and then
right now what's happened, we triggered a commercial buying panic. What that means is that the commercials got themselves bared up. They normally are right, but every once in a while they get caught misinterpreting the market. And so when your natural seller becomes a buyer in an uptrending market, you get the blow off top. And that's what we've been involved in, this 90 cents to $1.20 blow off top. The commercials are buying back in. That typically is a very, very late. When that occurs, Casey, that's like ninth inning kind of action. That happens at the very end of a move, not the very beginning of a move. But you can get the most dynamic part can happen at the very end before it blows its top off and then has a crash. So we're in the blow off top phase. There is a person out there I'm aware of who has the ability to tell anyone when a blow off top is going to finally exhaust itself, other than to recognize when you're in it. When we're in something like this, Casey, and I'm a producer and I'm trying to decide what to do, first of all, you just have to decide, is $1.20 enough for you or not? Even if it goes to $1.50, you're doing rather well, okay?
To say the least.
You're doing rather well. But for those that say, look, I sold a bunch of cotton too cheap, I didn't catch it right, I still got a little cotton left, I want to go for the golden ring, this is a good opportunity for put options as a producer. Say, look, I want to stick it out. Maybe it's going to go to $2 again like it did back in 2010, 11, 12. Who knows, right? So I want to, I don't want to sell any more cash, but obviously, I don't want to give up this price either. This is a great opportunity to layer in some put options, to lay some floors under the market for under your production, and to go do it that way, to keep the top side open and see if you can't catch a flyer on the remaining cash that you haven't sold. That's the only way I know how to handle a market like this. But understand, it is late in the game. And when you're looking at December 22 cotton trading well over 90 cents, there's not a whole lot of times, Casey, that you had an opportunity to lock in a plus 90-cent price a year ahead. It's pretty, this is good times for cotton producers. This is happy times. This is good times. So they're very profitable. They can be very profitable. And I would just keep in mind how profitable you are, and don't lose sight that, high prices are going to bring a production response. It's going to do it globally, and just keep that in mind. And once again, if you're uncomfortable doing the cash sales for 2022 yet, just buy some put options, get some floors on the market. Just don't be stupid and not be unpriced when this market decides it wants to give up, 10, 20 cents a pound really in a hurry. Just don't be caught not having something protected on what are some pretty exciting prices right now. So,
yep. All right, last thing, oil. Oil has had some pretty big volatility here of late. We're seeing $2 and $3 swings during the day and overnight and those kind of things. It's over the $80 mark, which hasn't been there for a while. A lot of talk about oil getting to $100 and higher and those kind of things based on inflation. Saudi Arabia and the OPEC countries have also made it very clear that they're not going to let the oil price get so high that basically United States competition can start climbing back into that. But with the current political environment we're in right now, it seems like that's really a non-factor. So I guess as you take a look at what's going on in oil, what are your thoughts there, especially as you start looking at natural gas prices and all those kind of things?
Well, OPEC can say whatever they want. They're going to produce more oil at 80, 85. They're going to,
sure, absolutely.
They're going to produce more oil. They're going to sell that. So don't listen to what they say. Watch what they eventually do, and they're going to they're going to produce a lot of crude oil here. But look, there's no way that the global economy is going to be robust with inflation running amok like it is right now, with food and energy going up. Everyone's disposable income is being contracted. It's just we worry about the demand side of the equation. Remember, heating oil to heat homes is for on a cold winter is only a portion of the demand for crude, right? I mean, diesel for trucking and diesel for and gasoline for cars. I just worry that the demand side of the equation, Casey, is being overestimated right now. And so I kind of see the potential for demand falling off or disappointing here as we go into the first quarter while production picks up. And so I just have a hard time getting excited about an $80 or $85 number going to $100. It could happen, it certainly could happen, but I don't think so. I think more likely we'll make a run down to 70 or 75 and take some pressure off, and kind of deal with the potential for some falling off in demand. Of course, remember also if our winter forecast is correct and you have a lot of blizzards and a lot of snow, that means a lot less people are doing a lot less driving than they would have otherwise because they're going to be landlocked. I mean, you got to think about all these things, So I'm just not excited about crude oil here. I just think it's topping out. We got hit last couple of days. We're bouncing a little bit, but I just think we're in a topping pattern, and I would be worried about a break into the first quarter. So,
right on. Well, good stuff as usual, Shawn. If folks want to reach out to you and get more information about what Hackett Financial can do for them in their operation, what's the best way to do that?
Our website is Hackett, Hackett, advisors.com. All kinds of different pieces of information on there that goes over how we look at things, how we look at weather, our natural climate cycles, our capital flow algorithm, to see if those tools may be of value to your listeners.
All right. I am Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. You'll find all the latest editions of the Moving Iron Podcast. When they come out, they'll be there. Also go to MovingIronLLC.com for all the latest news surrounding Moving Iron and the Moving Iron Summit, which information should be up there soon. So with that, I am Casey Seymour with Shawn Hackett. Let's move smart, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to axontire.com.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.